So again, I appreciate everyone joining tonight. Startup425 for the session, How to Finance Your Small Business. And we have Janie Seiko, Ellen Miller-Wolf is with us from Startup425. And Ellen will start off first, and then Janie will take over from there.
Hi, good evening, everybody. I'd like to welcome you to the third foundations class of this season. We will also be doing the class again in the fall, but welcome. And I am Ellen Miller-Wolf, and I work for the city of Kirkland, and I manage the alliance, which is called Startup425, which is bringing you this foundations effort tonight. I also am a partner in the Innovation Triangle, which is a recruitment effort among 3 cities on the east side to recruit technology businesses internationally. Yeah. So as many of you know, and I know these are difficult times, these are some numbers that suggest that 60% of small businesses fail in the first 5 years, underserved businesses, many of them owned by women or minorities, people of color. They lack mentors and they lack networking opportunities. Underserved businesses have limited access to what we call the 3 M's, markets, money, management, and underserved businesses are hardest hit, as many of you know, by COVID-19. So what Startup425 aims to do is to help businesses, especially those businesses that don't have immediate help, a handy accountant, a handy bank, a handy lawyer. We are an alliance of 5 cities, 5 governments, Renton, Bellevue, Redmond, Issaquah, and Kirkland. And as I mentioned before, Kirkland is administering Startup425. We are funded by the King County Library System, very often speaks on these foundations about all the resources that are available at the library. I would keep that in mind. Funded by those cities that I just mentioned, and also very generously funded by the Port of Seattle, that obviously is the importance of small business is key to their own energies in the economic development world. Again, we provide access and tools that experienced workers and entrepreneurs need to go from an idea to a working business in a successful and sustainable manner. We're also very much involved now in recovery. Janie may talk a bit more about some of the COVID resources available from the financial world and government. But our interest is that businesses grow, and they grow reliably and sustainably. And that's why we teach the courses that we do online with our support from, I forgot to mention, from SCORE. We lower the barriers to entry for non-traditional and first-time founders, keeping our ecosystem diverse and encouraging spontaneous collaboration. And we provide pathways to prosperity so that the whole community can share in the prosperity that is the East Side. This is a quick glimpse at our curriculum. You are taking our level 101 foundations workshops, which is kind of a primer and a lot of things that you need to know to think about starting a business, sustaining a business. Level 201, Small Business Essentials, which we will likely teach in July, excuse me, not July, in August, is very, very similar to level 101, a bit more of a drill down into the subject matters, but similar subject matters. And then Springboard Accelerator is also called the Innovation Lab, and it's for existing businesses with a focus on very small businesses, diverse businesses who want to scale quickly and want some help to do that. It's taught in partnership with Bellevue College, It will be taught in the fall. It's open to everyone, and I hope you take a look at it. In addition to our classes, we are also very much involved in responding to the COVID, and the terrible impacts to our economy, and particularly to small and diverse businesses. We have a business response team that can provide information about federal loans, federal grants, grants that each of the cities is involved in, and also King County and the state. We have a site where a lot of those resources are discussed, Startup425, which you see down below. And in addition to the resources, we also are funding Business Impact Northwest, which is a CDFI, works with diverse and underserved businesses routinely, and they are providing one-on-one consultation during this COVID season for businesses that are interested. So I would suggest, if you're looking for PPP, and obviously that deadline was extended and many of you know that, I would look us up on Startup425. We can put an appointment together with you immediately with a business advisor, and that person can help you one-on-one, hopefully within 24 hours. We've been trying to meet that deadline with whatever issues you're having. So another commitment to small businesses, the business response team.
Thank you, Ellen.
That's it. Thank you very much.
All right, so next we have Jenny Seiko from the SBA, and I think she's going to switch it up a little bit tonight and start with Q&A. But after that, if you have questions going forward, once she begins, please don't hesitate to throw those into the chat. So Janie, take it away.
Well, thank you to everyone for having me here tonight. It's always fun doing this particular presentation because although I work for the SBA now, I was a commercial lender for over 30 years and doing small business lending to startups and existing businesses using the SBA program. So it's always fun doing this particular event. So what I'd like to do is just open it up for some Q&A. So if you'd like to unmute yourself and go ahead and ask a question. If you have something you'd like to know that's burning, you know, let's get it off the table right now, and then I'll go through the material, and then we'll have Q&A as we go through this presentation. So does anybody have any questions?
Yeah, I had a question. Can you hear me?
Yes, I can. Mickey from Iowa.
Yeah. Sorry, I laughed because I had to put Mickey from Iowa up. Anyway, my name is Robert Hill, and my question was in regards to like credit. I understand like having an LLC is another entity besides yourself as a person, as a sole proprietor in comparison to. But my question was, do you as a personal business owner have to have good credit in order to qualify for loans?
Well, you know what, it's better for you to have a solid credit history on a personal basis. That helps you, makes the process easier. However, sometimes that doesn't align with real life, and you may have had some slow pays or some problems on your personal credit history. And the Small Business Administration programs help a lender mitigate some of that lower credit score. When you have a separate legal entity, like a limited liability company or a C or an S corporation, you are separate from your business. But for most of you that do need to have money, you will be borrowing with a Small Business Administration guarantee program. And as a result of that, you will be asked to personally guarantee the loan. So any 20% or more owner in a business is mandatorily required under the Small Business Administration Guarantee Programs to personally guarantee the loan. And as such, a credit report will be pulled on you. So what I would say is if you're applying at a traditional institution like a bank or a credit union, you're probably going to be looking at a minimum credit score of 650 to maybe 685. And then with an SBA guarantee tied to the loan request, you may be able to get a little bit lower score and still be able to get funding. So credit, your character, your credit reports, those are one of the things I'm going to do a little bit deeper dive into as we get through this presentation. Great question. Anybody else? You can all be brave. This is a real tough time for getting money, I will say, with the COVID issue and the economy the way it is. You know, it's a little bit slower right now than normal, but you know, there's still access to funding. Okay, well, I'm going to share my screen. Uh-oh. Host has disabled screen sharing. So, Dean?
You are now co-host.
Okay, good deal. So I'm going to open up my PDF and I'm going to start from the beginning. And I'm going to say I do this old school, so forgive me. But what you should see is Startup425. And we're going to do a little utilization and primer on the US SBA programs, the state's resources that may be available for you. We're going to cover why businesses fail. And then we're going to integrate what we call the 5 C's of credit into your business plan to help you get through the loan application process. And then we're going to cover a little bit about alternative sources of financing. And certainly, if you have questions as we're going through this, please put them in the chat. And then Dean will let me know if you have a question or two. Okay. So
are you sharing your screen?
I am. Can you not see it?
We cannot.
Okay. I clicked screen share. Let me go back. Try again. Can you see it now?
No, you may have to either share into the PDF or the actual Adobe app or your desktop.
Okay, you know what? I'm going to go like this and start kind of over here. All right. Where's my little PDF here? Share. Okay. Can you see that?
We see your
read the
web browser.
report.
Yeah, read the report. We can see
Okay. Okay. You know what? I'm going to have to do this a little bit differently. Hold on here just a second. Okay, so pardon me. I thought I had everything ready to roll.
No worries.
All right, now can you see?
We can.
Good. All right, so I'm going to get rid of that. And now you're going to see my PDF. Okay, so that's where I was. Utilization and primer, excuse me, on the US SBA programs, state resources, etc. So what I start with is a little bit of a introduction into why we use the SBA programs to help you as a small business owner or a startup obtain financing. And what I want you to think about is you take the role of being a lender. And if you have two tools, one being a conventional bank loan or credit union loan, and then the other is you have an SBA product, let's look at the risk differential. So let's pretend that I am trying to do a $100,000 loan for a startup business. If I were looking at a conventional loan with a $100,000 loan amount and no SBA guarantee and no potential for a recovery from the Small Business Administration, the potential estimated loan loss is the full amount of the loan, $100,000. However, if I do the same loan for $100,000 in conjunction with a Small Business Administration guarantee, the guarantee percentage right now on a $100,000 loan is actually 90% because we're in a little bit higher risk environment with COVID-19 impacting the economy. The standard guarantee from the SBA is 85%, as in this example. So what that means is that if your lender does a loan for $100,000 and then your lender applies to the SBA for a guarantee, the Small Business Administration would offer your lender an 85% coverage or guarantee on the loan. And in the event of default, the lender could go back to the SBA and, based on whatever the outstanding balance is on the loan, request or exercise an 85% guarantee on the defaulted loan. So in this case, the worst case scenario is that the loan defaults immediately at $100,000. The lender goes back to the Small Business Administration and says, we're exercising the federal guarantee. Please pay us $85,000. And the estimated loan loss now, in a worst case scenario for the lender, is $15,000. So every lender's job is risk mitigation. We need to try to always have the lowest potential risk. So if you are doing a $100,000 loan on a conventional basis and the loan loss is potentially $100,000, okay, I got to get rid of that little doohickey there, versus $15,000, what would you do? More than likely, if you were a lender, you would try to do the loan in conjunction with a Small Business Administration guarantee and mitigate the risk to $15,000. That's what the lenders are doing every time they're evaluating a loan. But here's the deal. Not all loans are eligible for an SBA guarantee. All right. And typically, the lenders utilize the Small Business Guarantee Program for a few reasons. One is if you're a new business, and the SBA defines new business as you being in operation for 2 years or less. And that includes brand new, I haven't opened my doors. All right. There's a lack of earnings history. And what that means is if you have been in operation for, let's say, 5 years, but you've had sporadic profitability or cash flow in your business, in the example of maybe you had a couple of years of losses, or you've had a profit and loss and a profit. Okay, that's a lack of earnings history because it's been up and down. So that takes on a little bit of repayment risk in the lender's eyes. So that's what we mean by lack of earnings history. The other one that is actually the most common reason financial institutions use the SBA guarantee program is for insufficient liquidation value of collateral. Well, what does all that mean? Well, it simply means this. if you have business assets in the form of equipment, let's say, and that equipment costs $100,000 for you to put in your business, if the lender had to go out and do a fire sale of that equipment, they may get 5%, 10%, 15%, 20% of what you actually paid for it. So the liquidation value has a very specific formula. We're going to go over that later on in the program. But again, purchase price and liquidation value are two different things. And it's very frequent that especially startup businesses or relatively new businesses do not have the ability to fully support their business loan based on the liquidation value of collateral. The other thing that the SBA allows is for longer loan maturities. And here's what I want you to think about. Think about the longer a loan goes out, 5 years, 7 years, 10 years, the smaller the monthly payment. And so if you have a traditional loan for equipment, maybe the lender is going to do a 5-year repayment. But if you do it with the SBA guarantee product, you can go out 10 years. And that makes a substantial difference in the amount of the monthly payment and how long you can stretch the cash flow that you actually have in your business to make that payment reasonably and comfortably without putting your business in a weak cash position. Sometimes there's limited capital from the business owners. And by that, I mean that as an owner in the business, you may have limited personal resources, limited savings, limited retirement plans, limited equity in your home to do a capital injection into your business to help fund that operation. And lenders often allow a lower than traditional capital injection by you as the owner into a business in support of having an SBA guarantee on the loan. Sometimes there are industry considerations. And I want you to think about businesses that may be higher risk. Higher risk is relative, but think about a hotel or a motel. The real estate value is there because it is real property, but that real property is valued based on the cash flow that the hotel or the motel is generating. So you could have real property, but have significant fluctuations up and down in the market value of that asset. In this consideration, the SBA is a perfect resource to get a guarantee on the loan to help mitigate the changes in the value of the real estate based on changes in cash flow. Other industry considerations. Think of a gas station or a gas station convenience store. You have environmental risk. You could have a situation where there's contamination on the property as a result of a tank leakage. That can cost a lot of money. And again, lenders tend to be concerned about lending onto those properties. So that SBA guarantee helps mitigate that risk. So those are the typical reasons why a lender would utilize an SBA guarantee to help do a loan. Okay, so what I'm going to do here is scroll down a little bit. And what I want you to know is that you have a great resource in the website at www.sba.gov. And it really is a link to many resources regarding all aspects of business operation and how to help you be successful and manage your business. There is an entire section devoted to startup businesses or relatively new ones. The other link that I want to share with you is the organization that Dean is part of, which is SCORE, or the Senior Corps of Retired Executives. I put in this link for www.seattle.score.org because it has a lot of information for you in terms of the actual documents you need to put together for your business plan, including business plan samples and formats, as well as supporting documents like a balance sheet, an income statement, a cash statement, a cash flow projection document. And it really, excuse me, enables you to work through the process of creating that business plan. And what I want you to know here is creating that business plan is very important for you because it gives you the ability to start goal setting for your business. And with any goal, you may have to modify it or change it over time. That's fine. But this business plan gives you the nucleus to say, this is how my business is going to look. Who's going to own it? Who's going to do what tasks? How I'm going to develop a marketing plan to penetrate my client base, how I'm going to deal with competition, how I'm going to perform on a projected basis as far as my financial goals, and how I'm going to collateralize the loan and really get in there and make this business work. Okay. As part of that, talking about your skills and your abilities is key and critical to the success of obtaining money for a startup business. All right. And we're going to go through all of these things as we go through the 5 C's of credit. So what I want to share with you is the SBA loan guarantee process. So you have an idea of what happens when you apply for an SBA guaranteed loan and you work with a lender. So here's a summary of the loan guarantee process. You as the business owner apply to a financial institution for a loan. The institution processes a request and they make a determination as to whether or not you can have your loan on a conventional basis, or if they need to process the loan in conjunction with an SBA guarantee. If they decide that they want to work with the Small Business Administration's guarantee, the financial institution applies to the agency. The financial institution closes the loan, which means they prepare all of the loan documentation. They do all of the servicing of the loan. The SBA pays a guarantee to the financial institution in the event of a loan default. Here is the catch. Usually, there is really no interaction between the Small Business Administration and you as the borrower. All of the interaction you have generally is with your lender of choice, and you can choose who you want to borrow from and have a long-term, hopefully, relationship with as a lender. And what I want to point out here is that if you struggle to find a financial institution to help you locally, what you can do on the Small Business Administration's website is go to the main page, sba.gov, and in the search indicator, you put in lender match, and then you will have an ability to put information in about your business. And then that lender match opens you up to nationwide SBA lenders. And if they are interested in doing a loan for you, then they will contact you based on the information that you put in lender match. Okay. And it's not a lot of information. Basically, you're talking about the business name and how to contact the business owner and what you want to have the money for and roughly the amount of the loan. Okay. So here's the other thing I do want to point out. Even though there is a Small Business Administration guarantee on your loan, that is to protect the lender risk. You as a business owner are still obligated for the outstanding loan balance, including what was honored by the SBA. So when a loan is actually, the guarantee is actually exercised by the bank, the loan is split into two: the portion that the lender carries, and then the guaranteed portion of the loan, and that is carried by the SBA. When you go through and put up a payment plan, and you negotiate that with the lender, then what happens is when you start making payments again on your loan, the payment is then provided to the lender. The lender splits the payment between the percentage owed to the financial institution, and then they remit the percent that is guaranteed to the SBA. And the whole thing that we want to have you do really is not default on the loan. We really want you to be in a situation where you're repaying it. So as a result of that, we go through an analysis process to try and make sure that you are going to be successful in your business. And again, that's the 5 C's of credit, which I'm going to get to here shortly. There are state resources available for you as well. And if you are a veteran, the first thing I want to do is say thank you for your service to our country. The state of Washington has a Department of Veteran Affairs, and the website is here. It's dva.wa.gov. And then if you are a woman-owned business or a minority-owned business, you can work with the state of Washington's Office of Minority and Women Business Enterprises, and the website is omwbe.wa.gov. And both sets of data here do a couple of things. One is, as we scroll down, you can get certified as either a veteran-owned business, or if you're not eligible for that and you are a woman or an ethnic minority-owned business, you can be certified as either one or both of those. The really good thing for you, for our state, is that we have this program called the Linked Deposit Program, and that will give you up to a 2% interest rate reduction on your eligible business loan. It doesn't have to be guaranteed by the SBA. It could be a conventional loan, but you do need to be certified as either a veteran, and there's a separate funding bucket for veteran-owned businesses, and then, or you can be certified as a woman or an ethnic minority-owned business, or both. You can have certifications in all of the categories if that's applicable for you. And then you can participate in these linked deposit programs. Again, there's a separate bucket for women and ethnic minority-owned or certified businesses. And the interest rate reduction, again, is up to 2%. Without getting into a lot of detail, that interest rate reduction is tied to the 30-day CD rates of the institution that you bank with. All right. So right now, the 30-day CD rates are well below 2%. But as they go up and increase as the economy improves, then your interest rate reduction can go up and be maxed out at that 2%. Okay. The other thing I do want to point out is that on dva.wa.gov, there is a list of certified veteran businesses in our state. And the same is true on the OMWBE website. And it has a list of the certified minority business enterprises, women-owned businesses, and disadvantaged business enterprises in the state of Washington. There's a lot more information on there. It's all designed to help you get in business, stay in business, and contract and perform. The one thing I do want to point out right here is that the SBA has what's called an 8A program. If you are certified as a veteran-owned business, a minority-owned business, or a woman-owned business, you can participate in the program. And the 8A program helps you contract with the federal government. The program is 10 years from start to finish, and you work with an advisor at the SBA, who we have one in the Seattle office, and we have one in our Spokane office, and they will work with you as a business owner to help you get and engage in contracts with the federal level. Okay, so it's a really great program, and I would encourage you to go through the certification process if applicable for you. All right, so here's the depressing part of the program. And I really don't like having it in here, but what I want you to think of is that there are reasons for business failures. All right, and the whole goal here of you attending training like this is to really avoid those pitfalls so that you don't fail, that you're a success, because that's what we want you to be. So I pulled a while back some of the top 10 reasons for business failures. And I did pull the New York Times and then Small Biz Trends. And here's the thing. Sometimes the math just doesn't work, or you're starting the business for the wrong reason. You really don't have enough of a client base to make the business successful long term. So identifying that is really critical. And I have to say that we have an outstanding public library system that supports this whole network of 425 startup. Okay. And the thing that I want you to know is that the public library resources are outstanding as far as business information. And they can help you with learning about the demographics of your client base, who your competitors are in your market area, and wonderful resources about your industry and how to properly price out your product or service. So they're a wonderful resource and they're of no cost to you. It's just a matter of working with the business librarian. Okay. So some other problems here. Well, let's say you just don't have enough money to keep your business in operation. That's a lack, what we call a lack of capital, a lack of cash. That's why borrowing money and using your own resources is really important to the long-term success of the business. You may not be able to manage people well, to maximize their productivity for your business. Well, you can learn to be a better manager and or have those skills in your work history. So what you need to think about is, what are the skills I need to be successful in my business? Do I need to manage people well? Do I need to manage my cash well? Do I need to understand basic accounting? Do I need to understand all of the aspects of my operation? Have I planned well to manage the periods where I may not have a lot of cash? Okay. Sometimes business owners don't want to delegate. They don't want to let go. And that's, a symptom of being a dysfunctional manager. You want to keep control over way too many things, and you can't do everything well and successfully because there's just not enough time in the day. So if you're managing your business well, delegating your tasks out, managing your employees for their performance, these are all important things that provide success in your business. Okay. Having a good handle on your accounting system and being able to manage the finances of the business are really key too. So think about, don't let them business manage you. Don't let your employees manage you. You are in control. You can manage these things successfully. If you feel like you have weaknesses in some of these areas, or you need to have support, what can you do? Well, you can educate yourself to do better. You can hire people to help you with the accounting, the bookkeeping, and or human resource management. You can do all of those things, but that's up to you to decide. But these things are offered for you to think about how to make your business more successful. Okay. All right. So let's keep going. Are there any questions? Dean, do you want to interrupt me before I get into the 5 C's?
I just answered one in there about the 8A program. I gave the SBA's website. So
great. Okay. Yeah, the SBA's website is fabulous. And you know what? Scores is too. So they're the best resources that I can think of for small businesses. Okay, so now what we're going to do is we're going to talk about the financing criteria. And what I want you to really think about is how to incorporate these 5 concepts of the 5 C's of credit into your business plan effectively. And you control that. These are positive things for you, okay? Don't try and make it hard, because really, when you're thinking about your business and its success, and you're talking about these 5 concepts, it should flow very easily from you. Even if you have someone help you put a business plan together, think that you control the information. And you really need to, because if you're providing a business plan to any lender and they're looking at it, you will need to be able to address questions that they have. Okay, because a business plan document is not going to answer 100% of everybody's questions. All right. And again, as a lender, I always dug through everything to make sure that I really had a good understanding of what you wanted to do, how you were going to do it, and that you had the skill base to be able to manage through that. All right. So let's talk about the financing criteria and what we call the 5 C's of credit. The 5 C's are capacity, cash flow, capital, collateral, and character. And we're going to talk about each one of these things in depth. And the reason I put it in that order is really because I feel like that is the order of importance to some degree. And also it's the order in which you have to be responsible, and you have to have an understanding of these pieces and which ones the SBA can help mitigate weaknesses on. All right. So capacity really is key. What is that? Well, many people have different definitions, but when it comes to the Small Business Administration and your ability to borrow money, the question you have to answer about capacity is, do you have the ability to achieve performance in the business? And how does the SBA have lenders measure that? Well, we look at your resume and your work history. Ideally, you should have at least 2 years of recent industry experience and or transferable skills to qualify for a startup business loan. All right. And what we're talking about here is truly industry experience in the business you want to start. Transferable skills are skills that you learned over time from work in other jobs and or education or certifications, sometimes as hobbies. Okay, what you do for fun may actually transfer into creating a business for yourself. All right. So what are we looking for as a lender? Well, we ask you to provide a resume for each 20% or more owner of the business. You may also have to provide a resume for key people in your business who are employees or even contract labor. So you need to think about who's important for your business and how do they impact your day-to-day operation. So let's start with you and any other 20% owner. When you're looking at a resume, I tend to look at resumes all the time, and they start out, okay, this is my goal, this is what I want to do. And then they start talking about their work history, where they worked, how long they worked there, what their title was, and what their responsibilities are. Well, I want to challenge you to put more information in there. What I really want to see is information about what skills you developed and garnered in each one of those jobs. Okay. And I'm going to stop for just a second because I need to turn the light on because I'm in my office and it's dark. So hold on. There, that helps a little bit. Thank you. All right. Pardon my interruption there. Okay. So the resume. Here's the deal. I want to know what you did, how you were successful for your employer, what skills you garnered, how you utilized your position to enhance your skill base and provide productivity for your employer. And I'm going to give you myself as an example. When I was a lender, I could easily say, okay, my job is I need to generate small business loans in my community, whatever community that was. Well, I had goals. So I was supposed to generate a specific number of loans per year, and that was fine. And I was supposed to generate a certain amount of loan fees. That's fine. But I was also supposed to have risk mitigation and minimize my loan losses. Okay. So my resume would have information about my job, how long I was there, and what my responsibilities were. But the more important thing for me to put in was, these are my goals, but this is what I really accomplished. This is the number of loans that I did in a 12-month period of time to enhance the profitability of my employer. Oh, and by the way, not only did I generate loans, but I generated loan fees that provided support for my compensation and helped compensate my employer. The other thing is that my loan losses were significantly lower than most lenders in my position. I underwrote loans at a very high success level. Why is that important? Well, when 30% or more of my portfolio was for brand new, never opened their doors businesses, and my loan losses were less than 3% on an annual basis, that's a very high performance level. Okay. And so I wanted to share my successes and also talk about the growth of the portfolio and how my borrowers expanded and grew within the confines of the borrowing needs of them as they expanded and developed their business, and again led to more profitability for my employer. Okay, so if you were reading that, would you hire me? I don't know, but I'd have a better shot at getting a job if I explained my capacity and what I did. And again, going out, doing training like this and educating my client base and really helping people do better in their business. Okay. So those are the things that you need to transfer into your resume. Beef them up, make them really strong. Don't think of a stick person. Think of someone who's, a little bodybuilder and that they're really beefed up instead of a little stick figure. And that's how your resume should look, because you want to talk about all the things that you know that are going to make your business successful long term. Okay. So you need to do that resume for each 20% or more owner of the business. All right. Along with the resume, what you will be providing is a personal financial statement, and you will be providing 3 years of your most recent tax returns. If you're at the beginning of a year like we are right now, you may be asked to supply, in lieu of a tax return for last year, your W-2s, so that your lender can analyze how much money you're used to making and take a look at your cash flow projection and make a determination about how much money you actually need to earn to maintain your lifestyle. Okay. So again, along with the resume, you need a personal financial statement and up to 3 years of business tax returns. And you may need to also provide W-2 statements from your last employer for the most current year. When you get to your key people in the business, I'll give you an example. I'm horrible with mechanics. Okay. If I ever wanted to do a business that was equipment based and manufacturing, where you needed to have equipment, I would definitely have to hire out for a mechanic, because I just don't have the capacity to do that. But in my case, what I would do is I would provide a resume of someone who has a mechanical background that I know I could rely on to support my operation and maintain my equipment so that I had minimal downtime. You would do that with maybe human resource people, with bookkeeping people, with accountants, with attorneys, anybody who's really of value, whether they're an employee or an independent contractor that you hire out a service for. Okay, because what you want to do for any lender in your business plan is really develop this image of how the business is going to function and operate and who you're going to rely on to be strengths in your business for success long term. Okay, so again, your resumes focus on your skill base as it relates to your work history, your education, your certification, training, whatever is going to make you successful in your business. All right. So there are a couple of exceptions to this. If you are planning on purchasing an existing business, or you're planning on opening a franchise operation. So let's talk about the exception if you're going to purchase an existing business. You have a seller who may be motivated to sell, but also provide you training and education for up to a 12-month period of time. And I want to emphasize that 12 months because the SBA rule is that a seller can only stay active in the business for 12 months after the sale date. And then they have to go away. All right. But you can learn a lot from a seller through the transition in training between introducing you to key vendors, introducing you to key clients, working with you to understand the nucleus of the operation and how to transition from the seller to you in that business role. All right. And again, you do have to have some nucleus of skill base that are transferable, managing people, managing finances, putting budgets together, have some acumen for purchasing, if that's germane and relevant. Other things like developing a marketing plan or having a basic skill in terms of whatever the business happens to be. Okay, so it's not all about the seller, but that seller helps you transition over to a different industry and utilize the skill base that you have. So for a person like me, if I want to transition from, let's say, a lending background into starting my own small business consulting operation, that would be a pretty good transition for me. Okay. As it is right now, I am the co-owner of a retail fish business in the Pike Place market. So I don't know how I got there, but I did marry my husband and he was doing that. So I kind of laugh, but I am a small business owner and I understand the pitfalls and the joys of having a business ownership. So keep that in mind as I'm going through some of this information because it is firsthand for me too. Now, transitioning over to a franchise operation. If you look around and you find a franchise that you want to do and meet your needs for a business type, that's a great thing. Here's what franchise operations do. They provide you a marketing plan. They provide you a nucleus for an operation that is repetitive and repetitively successful. That's what you should be looking at. What are the successes in terms of the numbers of franchises that are still in operation for the franchisor? The most franchise operations provide a certification and training plan for you as a business operator to get through before they allow you to have your own independent location. So that certification process and training that they go through, that is also your basis for your skills. Okay. And that's why when you're looking at both purchasing an existing business or buying into a franchise operation, you don't have to have direct industry experience, but you do have to have transferable skills. Okay. Are there any questions before I go on to cash flow?
There is one.
Okay.
In reference to the resume, if you have relevant experience that was very long ago, but have gained skills more recently, should the resume prioritize relevance with gaps or recent chronological skill history?
Traditionally, it's going to be skill history chronologically. So you want to start with your most recent skill base. All right. And I'm going to say this. I did a loan not that long ago where a man wanted to do a franchise operation in a restaurant. All right. And his work history was probably 10 or 15 years old in terms of relevant restaurant experience. And he did several other things in between. But those in between things helped him develop his skill base in other areas that would help him be successful in his business. So what I would encourage you to do is go through chronologically with the resume on your most recent employer first and talk about the skills and go back, to the point where you actually do have industry experience. Highlight that. In what I would do, if it's been more than probably 2 or 3 years since you actually worked in the industry, what I would encourage you to do is put a little bit of a descriptor in your business plan about why your skills are still fresh enough for you to be successful in the business operation. Okay. Any other questions?
I don't see anything.
Okay. So let's go on to cash flow. And I'm going to scoot down here because I want to see something before I start talking. Okay. So here's what I want to, I'm going to do here. I'm going to give you a little bit of information, but then I'm going to open up a cash flow projection document because that's really the relevant thing that I want to show you here. All right. So next, that's really equally as important, but comes out of your skill base and your capacity is the cash flow projection document. All right. So the question you're trying to answer here is, does a business have an ability to generate an adequate cash to repay the requested debt and meet all of your operating expenses in the business? Okay. So for startup businesses, what you need to do is you need to put together a 2-year cash flow projection with assumptions. So some of the things that I want you to think about are, when you're putting down numbers on this cash flow projection document, are the sales or revenue really achievable? Do a little bit of a logic path. Think about the number of hours you need to work. Think about the number of customers you're going to have to bill or turn in terms of a day or a week or a month to help you achieve your numbers. Think about the cost of goods. Is it reasonable? Do you have relationships with providers of your raw material or your goods? Do you have contracts that hold prices? How long will those prices be held for? Globally, when you're thinking about your fixed costs, your operating expenses, are they reasonable? Have you covered everything? Okay, so here's what we're going to do. We're going to go in and open up an actual cash flow projection document. And we're going to go into my favorite place. And it is seattle.score.org. And we're going to pull up rid of those. Okay, so this is one of the websites that I was telling you about, and then sba.gov. Okay, so here they have a bunch of resources in terms of workshops, like what I'm doing for you today. And then let me go back up here. I haven't been in here for a little while, so I have to kind of look for a minute. We're gonna just do a search. I'm going to put in cash statement and okay, I'm going to go with this one and make sure it's the right one. Cash flow statement. Okay. If I just open up the file down at the bottom, I will be good to go. What's opening up is an Excel document, and it is the 12-month cash flow statement. And it's a little slow, so hang on here. This document enables you to estimate okay. Go to the okay. So what I like about this document that is an SBA, I'm sorry, a SCORE document, is that it's a projection. It's in an Excel format, and you can put estimates of your cash sales in here. Okay, enable editing. That's a good thing. All right, I want to get rid of that again. Sorry. And let's say I'm estimating $10,000 in cash sales, mind you, not credit accounts. What happens here is that $10,000 flows through to each subsequent month. And if you have expenses for things like, oh, gross wages, let's say that's $2,000. What happens here is all of these boxes are automatically populated as either pluses or minuses, right? And so you can see if I put $10,000 in cash sales and $2,000 in operating expenses, at the end of the month, I have $8,000. That's what my net is. And that $8,000 carries on. This is a cycling document, and it is what I kind of refer to as a living document in terms of your cash flow. When you're looking at this document, what I have people start with is not the projection of the revenue stream, but rather the things that you can control, your cash paid out. And what happens here is you can relabel these lines any way you want. So for purchases, I could say raw material number 1. Okay. I can say purchases raw material number 2. Okay, so you can change any of these descriptors to meet your needs. You can delete lines, you can add lines, not a big deal. But what's really important here is that if you start with your expenses, your cash paid out, the things that you can control, then when you get to the end of this, your numbers are going to be more and more and more negative. And I'm going to go back up here for a second and put 0 in the cash sales. And what you see is a negative number. And what I really advocate is for you to create all of your projected expense stream first. And then what you know is what hurdles you have to overcome in terms of your cash deposits into the business on a monthly basis. All right. And for all of you who are actual startup businesses, you may have 1, 2, 3, 6 months, depending on your business type, of negative cash positions at the end of the month, right? And have that be negative cash positions for consecutive months right here in this subtotal and total cash paid out. As we scroll down here a little bit on the page, and your cash position at the end of the month. If you're not generating revenue or not generating enough revenue to cover your expenses when you're starting out, this number may be negative for a few different months. Okay. And if you're a manufacturer, you may have 6 months of negative numbers. And then when you get to month 7, you may start breaking even or having that negative number be less and less. So conceptually, you don't want to run out of money, do you? No. So after you have all of your expenses and cost of goods loaded in, then you can go back up to the top and look at what your cash sales could be. If you have accounts receivable, in other words, you let people pay you over time for what they've purchased from you, you would then be entering numbers in this line, your collections from credit accounts. Okay. And you're going to make estimates of how much you're going to collect on a monthly basis from those credit accounts. If you get a loan, then you're going to put that dollar amount in there. For your equity injection for a startup business at the very beginning, you would put your cash on hand in that pre-startup estimated cash on hand box 1 up there. Okay. And this helps you define how much extra money for a working capital reserve you would need to have. And that would be based on looking down here for your most negative cash position during the 12 or 24 month period of time. All right. And you want to have enough money in reserve to cover that most negative period, because you don't want to run out of money and then not be able to pay your bills and or your employees or whatever else you have going on. Okay. If you do borrow money from a financial institution, you can estimate out what your interest expense is going to be. And normally on a true startup business, what the lenders do is they allow you at least 3 months of interest only payments. So you may have payments up here for interest expense on your loan, but you may not have a payment until month 4 on the principal portion. All right. And your lender can give you an amortization schedule, or you can do that yourself just by plugging in the internet in the subject line amortization schedules, and you can play with that. I would use an interest rate of 6%. And if you are doing a true business loan for working capital, equipment, leasehold improvements, keep your maturity up not more than 10 years, okay? Because that's the most you can do for that type of purpose with an SBA guarantee. If you're buying commercial real estate that your business is going to occupy at least 51% of, then you can go out to a 25-year repayment period, okay? But I would still use the 6%. You do need to pay yourself. So there is a line here for owner's withdrawal. And what I would encourage you there to do is think about having, doing a review of your personal debt obligations. And I'm talking solely your debt obligations, not discretionary expenses. And if you are renting a home in lieu of having a mortgage payment, put your rent in there. And all of your minimum monthly payments on your debt obligations, credit cards, car loans, boat loans, plane loans, whatever you've got, okay? Student loans, and add all of your minimum payments up and then multiply that by 3. That should be your total cash compensation from all sources that you have, in addition to what you may be drawing out from your business to help you meet those needs. So if you have the luxury of having a retirement or a pension plan and you're going to be drawing money from that, and let's say you feel like you need to have from your calculations $3,000 a month in total compensation, and let's say your retirement plan pays you $1,500 a month, then you would be looking at your business to pay you $1,500 for the remaining amount you needed to make up that $3,000 a month compensation. Okay. So again, take your minimum monthly payments on your debt obligations plus either your mortgage or your rent, take that total, multiply it by 3, and that should be your compensation amount. Okay, so that's a little bit of an overview of the cash flow projection. You can see the document, you can work with it. And what you need to also do here is for every line item that you're filling out, you need to write an assumption about it. All right, that's very key because your lender or anybody else looking at this needs to understand how you're deriving these numbers, how you've come up with them. All right. Okay, so that's the cash flow projection. What I'm going to say is the 2 most important pieces of your business plan, again, are describing your capacity and the capacity of your employees and anybody else you use in your business to help you achieve your operation. From that comes the numeric basis of success for your business in the form of the cash flow projection. Now, if you're buying a business, you will ask the seller for up to 3 years of tax returns so that your lender can do an analysis on the cash flow history of the seller as it is applicable to your purchase price. The lender will make sure that you're not overpaying for the business based on the historical cash flow the seller is generating. And I'm going to tell you right now, in these economic times, there may be opportunities to buy a business that work out very well for you. But what I would encourage you to do is, in this environment, when you've got a depressed economy, is take a look at the historical cash flow from the business, but also do or request monthly profit and loss statements for the last fiscal year to what is happening now, to make sure, again, that you're not overpaying for the business. All right. And when we're looking at cash flow for SBA purposes, a lender is actually looking at the net profit or loss, if that's the case. We're adding depreciation expense, we're adding amortization expense, if applicable, we're adding historic interest expense, and that is, when you total those, that is your traditional cash flow. Some other adjustments that we may, as a lender, make to the cash flow are adjustments for rent expense. And I'll give you an example. let's say you're buying a business and the seller has been paying $5,000 a month in rent. Fine. When you go in to negotiate taking over the lease, what happens if your landlord says, well, I gave them a screaming deal, but I'm going to charge you $6,000 a month now in rent because that's really what the market will bear? Well, what we would do here is make a negative adjustment for $12,000, 12 months of increased rent to that traditional cash flow number. Why? Because your costs are higher. Another one that we may make is, let's say the owner of the business is pulling out $100,000 a year in compensation, but let's say you only need $60,000. We would make a $40,000 positive adjustment to the traditional cash flow because you don't need to take as much money out from the business, and you can keep that in the company if you need to. So those are examples of adjustments that may be made to that matrix that I'm showing you right now when we're evaluating the cash flow in an acquisition situation. Okay. The other thing I do want to let you know is that we are normally looking at a multiplier, and we want your annual debt service, your payments on the loan, to have what we call a debt coverage ratio of at least 1.25 times. What does that mean? Well, if your cash flow is $1,250 a month, the maximum loan payment that we would like you to make on a monthly basis is $1,000. So $1,250 divided by $1,000 comes out to a ratio of 1.25 times. So when you're looking at your numbers and you're looking at your debt service, your monthly loan payments that you calculate, which is a combination of interest and principal, I want you to think about that debt coverage ratio. Okay? Any questions? Nope. Okay, we're going to keep going because I have a lot more info to cover in a short period of time here. But I really wanted to focus on the capacity and the cash flow because those are really the most critical things for you. When you get to capital, what I want you to think about is your capital is the amount of money that you're taking personally and injecting into the business. That is called your equity injection. And what things can you do that with? Well, you can do it with cash or things that are called in-kind assets. And what I want you to think about is if you have equipment or a computer or furniture or a vehicle that you need to use in the business, but you own them personally and you transfer that ownership from you personally into the business at market value, that's an in-kind asset contribution that counts as part of your equity position. Okay. Cash can be liquidated certificates of deposit or savings, or let's say you do a home equity loan and you borrow a portion of that from the home equity line of credit or term loan and you put it in your business. That's a capital contribution. You are transferring money from a personal asset and putting it in your business. That is your equity. What is the minimum amount that you need to contribute for an SBA loan? It's 10% of the total assets of the business to get your business going. So remember what I said, you want to have a cash reserve. Okay, that would be your cash amount on your balance sheet. If you need to have inventory, you determine what your minimum cash need is for the inventory, and you would budget that accordingly. Furniture, fixtures, equipment, anything that you need in your business, you are going to put on a list, and that's going to be your asset list. And then you're going to total that. And if you're talking to a lender and they said, what is your capitalization cost? That's just a fancy way of saying, how much is it going to take in terms of total assets for you to start your business? Okay. And if you're doing a loan in conjunction with an SBA guaranteed product, your minimum contribution is 10% of that total asset requirement. So you can be structured any way you want. You can be a sole proprietorship. You could be a limited liability company. You could be a sub S corporation or a C corporation. And they all have a little bit different equity names on the balance sheet. Okay. But this is mainly what they look like. All right. So regardless of what type of business entity you have, doesn't matter, but what your lender is going to evaluate is your leverage ratio or your debt to equity ratio. And what they do for that is they take total liabilities and you divide that by your equity contribution. Okay. So total liabilities in the business divided by your equity, that's your leverage ratio or your debt to equity ratio. And the higher that ratio is, the higher the risk in terms of what the lender is looking at. Again, what you can do with an SBA guarantee is put in $1 of debt for every $9. I'm sorry, $1 of equity for every $9 of debt. That's a 9-to-1 debt to equity ratio. That's fairly high. But when the lender has an 85 or 90% guarantee or 75% guarantee on the loan, that is a risk mitigant to having that higher debt to equity ratio. And that's one of the reasons we use the SBA guarantee as a lender. A lower risk aspect of this is if you have $1 of debt for every $1 of equity. That's a 1-to-1 ratio. So that's very low. All right. And that's an illustration of it. Okay. So this is about the equity contribution. And one thing I do want to point out is that if a seller is willing to carry a note payable, and they are willing to sign what's called a debt subordination agreement with your lender, that seller note can be part of your equity contribution. Okay. And then instead of it being a 10% minimum, your equity contribution can be as little as 5% if the seller is willing to carry a note for 5%. Okay. And what I want you to know there in right now, as the SBA rules are written, if a seller does carry a note for a portion of that overall 10% minimum contribution that you're putting in, the seller does have to wait for the lender loan to be paid in full. Okay. So that is a consideration. All right. You can get money from family members, from friends. They can all, if they want to lend you money, they can sign a debt subordination agreement as well. And that can be part of your equity contribution too. All right. So there are a number of ways creatively to come up with that equity contribution if you don't have enough cash on your own. All right. Any questions?
I'm not seeing any.
Okay, we're going on to collateral. And as I said earlier, this is the one where most of the time you run into deficiencies. Well, why is that? Because again, if you're getting a loan to borrow money for a brand new piece of equipment, and let's say that that equipment is worth $100,000 purchase price, brand new. Well, the SBA is going to say the liquidation value on that is 75% of the purchase price. So automatically you have not $100,000 in collateral for that equipment, you have $75,000. Okay. If it's used equipment, the advance percentage is 50%. So you buy $100,000 in used equipment, it has a liquidation value of $50,000. So what I want you to know is that for each type of collateral, there is an advance percentage that is assigned to it. And if you're doing a term loan, let's say 5 years, 7 years, 10 years, accounts receivable and inventory at cost have a 10% liquidation value. That means that for every dollar of collateral that you have, it's only 10 cents in liquidation value. That's for accounts receivable and inventory. If you have equipment, we went over those. If you have furniture, fixtures, it's zero liquidation value. Leasehold improvements, again, more than likely zero liquidation value. So then if you are looking at, as a lender, the business assets that are collateralizing the loan and you have a deficiency, the next thing the lender does is they look at your personal financial statement to see if you have any personal assets that they can take to help you collateralize the loan. All right. Most often, they are going to ask you to pledge your home or other real estate, whether it's a rental property or whatever. Most lenders take what they need to get you to 100% liquidation value versus your loan amount. All right. In the situation where you do not have enough collateral personally and in the business on a liquidation value basis to fully support or cover the loan amount 100%, the lender will ask you for a life insurance policy for at least the amount of the deficiency. If this is the only source of income you have for yourself, then they may also ask you to have a disability policy. Okay, so all is not lost. Not having enough collateral is, again, the most common reason that a lender will use an SBA guarantee and then structure the loan accordingly. All right, we're going to go on to character. And here's the thing. Character is all about evaluating your personal credit history, unless you have an existing business and you're expanding. And then we look both at your personal credit history and how you have had your business pay its obligations. So what are we trying to test here in terms of character? It's your desire to repay your debts. Do you have a desire to repay your obligations? Well, again, what we're going to do is we're going to pull a personal credit report on each 20% or more owner of the business, because they have to personally guarantee the SBA loan. All right. And some financial institutions pull one credit report. They may pull it on Equifax, Experian, or TransUnion. Some financial institutions do what we call a tri-bureau pull, and they pull a combined report from Equifax and Experian and TransUnion. Okay, so here's what I'm going to say. You can get a free copy of your credit report once a year from Equifax, Experian, and TransUnion. I would encourage you to do that before you apply for any business loan, and do the same thing for any 20% or more other owner of your business. And make sure that you all are paying your obligations as agreed. Because you get one free credit report per year, it is a soft credit pull and it does not impact your credit score. Whereas if you sign an application with your creditor, whether it's a bank or a credit union, and they do a credit inquiry on your personal credit history, that is a hard pull. If you have 3 of those in a row in a short period of time, by the time they get to that 3rd pull, your score can plummet. Okay, because all of the software programs of all of the institutions assume that polls number 1 and number 2 resulted in a decline. And so by the time you get to number 3, your credit score is plummeting. So what I would encourage you to do is talk to the lenders you want to work with. Get an idea of whether or not you're going to be able to qualify for a loan under their credit criteria. Give them the copies of your free credit reports so they don't have to pull a credit report on you, and they can evaluate their willingness to do a loan for you. All right. And then when you select a lender that you want to go with, then sign their credit application and allow them to do one credit pull on you. Okay. And that helps you reduce your inquiries. Okay, so we have, if you have credit problems or a lower score, pay your collections, bring all of your accounts current, get judgments paid, liens paid, levies paid, whatever you've got. Quite frankly, now, if you pay as agreed on all of your obligations after you've had some slow pays or a bankruptcy or a credit problem, after about 6 months, your score is rehabilitated. For it to be really high, you need to go out 12 to 18 months. But for a rehabilitated score in the high 600 range, it usually happens within about 6 months. Okay. If you have defaulted on any federal debt, including a VA loan, FHA home loan, student loans, SBA program loans, U.S. Department of Agriculture, Business and Industry loans, you are ineligible to participate in an SBA funding program. Okay, so you want to be really careful that you don't default on federal credit programs. I want you to review your credit history. Make sure, again, that you're paying unpaid collections, past due accounts, all of these bad things that drop your score if you do have them on your report. If you have had a bankruptcy, okay, the acceptable reasons within the SBA are a marital dissolution, a job loss, or a catastrophic illness without insurance. If those were the triggers for any bankruptcy filing, those are deemed more legitimate. Okay. And what I want you to think about is, again, you really should be outside of a personal bankruptcy by about 5 years before most lenders will help you. But again, your credit score will be rehabilitated if you file a bankruptcy and start paying as agreed within about 6 months. Okay. The other thing I just want to share with you are some of the alternative sources of financing. I want you to think about your different sources of equity from you, things like your savings accounts, marketable securities, your pension plans, home equity. You can sell personal assets. You can get money gifted from friends or family. And the one I don't really like, but you can do, is you can borrow off of credit cards prudently. But pay them back timely, rotate them, revolve them so that you're not racking up a lot of personal credit debt. Okay. If you're in business already, you can look at customer deposits or a line of credit for financing, factoring, which if you've got accounts receivable, you can sell them to a factored company and they will discount the value of that account receivable and give you cash. An example of that is if you have a $10,000 account receivable, they may give you $9,000 for it and collect on it. You're giving up your right to that account receivable. Vendors may give you terms for purchases. You can liquidate stale inventory before it goes obsolete. You can lease things like equipment or vehicles or furniture or facilities rather than buying them outright and borrowing money for them. You can do a lease option because it's a lower cash contribution for you. You can borrow in terms of credit cards in the business entity name. And again, you can borrow in the form of notes payable from a seller or family and friends. All right. Those are all sources of getting money in your business. Okay. And then from financing options, you have lines of credit or term loans. You have support group agencies like the U.S. Small Business Administration or the U.S. Department of Agriculture to help you be eligible for funding. Those are good resources. And then I have listed some resources, what we call alternative lenders in our community. They are nonprofit revolving loan funds. The majority of them are funded in part by the Small Business Administration. They borrow money from the SBA and they relend it into the community. These may be your first option as a lender rather than going to a credit union or a bank. Their interest rates are typically a little bit higher than a credit union or a bank, but they do a great job of providing technical assistance and providing funding in smaller dollar loans for your business to meet its needs if you cannot get funding from a credit union or a bank. Okay. There are other resources like Pierce County Community Investment Corporation, the City of Tacoma Business Consortium Fund, the Lewis County Economic Development Fund, and Community Source Capital. These are all alternative sources, but they're more geographic based, clearly based on where the business is located. Okay. So the other sources of money that you can look at are crowdfunding, the Small Business Investment Corporation. That information is found on the SBA website. You can look at angel investors, people who have retired maybe from an industry, but still want to keep a finger in the pie, so to speak. And they can not only provide you with funding, but they provide technical assistance and work history in developing a particular industry. You can look at venture capital, or you can share you can share the ownership of the business by forming a partnership or a limited liability company or a corporation, either a sub S or a C Corp. And sometimes employee stock ownership programs, ESOPs, work well too. So I've gone over a lot of information tonight, and I'm only 6 minutes over. So thank you for hanging in there. We've talked about how the SBA product works to help you get funding. We've talked about the 5 C's of credit that you can use to develop your business plan. You've got resources on the SBA website and SCORE and alternative lenders. And if you need me, you can always give me a call on 206-300-3863. And my email address is janiesacco@comcast.net. You can also reach me at my SBA email address, which is janie.sacco@sba.gov. Okay, so I appreciate the time. And are there any questions?
We do have one question.
Okay.
And it's related to, the question is, if student loans were in default and you are in good standing, then would that make you eligible for an SBA loan?
As long as you are paying, okay, you can have IRS debt obligations, you can have debt obligations with any federal agencies. If you've renegotiated the repayment terms and you're on plan, you're perfectly fine.
Any other questions out there? I'm not seeing any other questions. I did throw a survey into the chat box, so if you wouldn't mind taking that survey, we would greatly appreciate it. We can only improve our programs based on your feedback. I want to thank Janie for her time, and she will be back next week as well to talk about SBA programs related to COVID-19. And as we learned today, the SBA PPP was extended through May 31st. So, and you can find that information on the SBA's website. So if there's no other questions, we want to thank you for joining us, and join us next week as well. And thank you very much, and have a great rest of your evening.
Thank you, everybody.
Thanks, Janie. That was great.
Thanks. You're welcome.